Now, I've spent the better part of this year studying the pandemic because I thought it really held the key to the market, at least for most of the professional money managers out there. And that was right. But you know what we've discovered? The professionals are no longer the only cohort that matters. We've got a massive group of individual investors who become, in many ways, a more powerful collective force than the professionals. And they simply don't care about the same things as the experts. And they're the ones who are the marginal buyers and sellers of stocks.
Today I'm going to share my opinion on Jim Cramer's thoughts on the return of individual investors in today's market. If you are looking for professional advice, this may not be it. But if you're here to hear my opinions and thoughts on where we are right now in this crazy market, you're in the right place.
In the last 8 months, though, that conventional wisdom has been stood on its head by a new generation of investors who came of age after the rise of commission-free trading. They're much more optimistic than the older generation, who are so beaten down they've given up on stocks. They don't care what Wall Street thinks. Upgrades, downgrades, price target changes means nothing to them. It's just gibberish.
Traditional industry is based on analysts and people who look at numbers. There's absolutely nothing wrong with that. However, just looking at numbers, you fail to see certain things that cannot be reflected on the balance sheet.
For the past 20 years, the conventional wisdom said stocks could no longer be trusted. They all trade together as a unit, which means they can tend to lose their value way too quickly when something goes wrong. That thesis only grew more convincing after the financial crisis. On top of that, the conventional wisdom insisted that only a fool would try to pick individual stocks. Too easy to be wrong. But you might as well stop trying to beat the market and just put some of your money in an index fund and park the rest in safely in bonds.
This current younger generation that Jim Cramer goes on to mention is the generation that a lot of boomers kind of hate. And that's the YOLO generation, the Millennial Generation, Generation X. They have absolutely no chance in today's market if they have to invest like the older people. That's because they really don't have time and the market is so expensive. It's really hard to make it. Jim Cramer goes on to say that the thoughts and the way these new investors are investing is completely different, and that turns conventional wisdom on top of its head.
These newer investors don't understand the appeal of index funds. You can't get rich with them. If you wait for the S&P 500 to admit Tesla, which they talk about all the time, you miss the best move of your life. The most interesting stocks might be gathered into ETF baskets that they experiment with, but mostly they prefer to do homework on individual names themselves because they know how to research on the internet.
The younger generation doesn't have that flexibility of income or stability. For the most part, I'm not saying that everyone falls into this category, but most of them are not able to diversify in a way that anything they invest in would be able to provide a significant return, since the amount that we need to retire today is a lot more than the previous generation. That combined with inflation, the enormous cost of living increase is just ridiculous. Even if you count inflation, our parents' generation did not have to spend as much as we have to today to get what they did back then.
They don't even care about traditional parameters of valuation like price to earnings or even price to sales. They only care about who's doing what's right and who's doing what's wrong. If they buy a stock that turns out wrong, they can always trade out of it for free because there are no commissions. They're not bound to anything. In other words, this pandemic has become the ultimate changing of the guard. But you might have missed it if you're not as plugged into what's happening with the younger generation.
The new investor, and I'm calling them the new investor, today they invest into companies they believe in. They want to see them succeed, so they'd rather put their money where they think there's going to be the most hope. That's a different way of thinking. All the information that I received was all based on this old mentality. And there's absolutely nothing wrong with that. However, it does miss out on these intangible concepts, such as ethics and belief. One of the ways a traditional analyst values a company is through the price earnings per share. Index funds are falling out of popularity with the younger crowd. And that is kind of true. When I started investing, I heard that, oh, you have to get into mutual funds because it's much safer than getting into individual stocks. I was taught about investing as something very risky, something akin to gambling. The defense that I was given as to why I should invest in mutual funds over stocks is that if something happens to the market and it affects that stock, for example, it's like throwing a rock at it and it breaks and all your money goes. However, if that same stock is in a mutual fund, like different panes of glass, if one of them breaks, the rest of the panes of glass is still going to be okay, so you don't lose all your money. And for the longest time, I did think, yeah, you know what, that kind of makes sense. Later on, there was a resurgence of index funds and ETFs, which the index fund that Cramer is talking about, that particular index is designed to be very comparable to a market segment as a whole.
Finally, these younger investors believe in environmental sustainability, not just as an ethos, but as a business model. They know there's money in cleaner energy. They like electric vehicles and hydrogen fuel cells. They take companies seriously when they talk about going green. Remember, they lack cynicism. They do their own research and decide whether to trust or not trust. When they trust, they pull the trigger.
For the younger investor, it basically boils down to all these things not really having that high rate of return that the young investors are looking for. They are more confident by going online and doing their research and going on YouTube and hearing what other people talk about. The younger investors do stock picking, just as Cramer mentions. They do meticulous research, and that research is done online. People today with access to the internet and the information that's available to them are able to come to more knowledgeable decisions with a much deeper understanding today as they would have done years ago. And this is only due to the advent of the internet being so permissible in our lives. It allows us to have multiple advantages today. This is their opportunity, and that's what people fail to realize. But you know what? Time is gonna tell, things are gonna change, and I guess that's enough of my rant for this particular video. Hey, if you liked it, as always, hit that thumbs up button, subscribe for more videos, and ring that notification bell to be notified when there's another one. Until then, take care.
The bottom line, I think it's time to stop disrespecting the younger investors who've nailed 2020 every step of the way. Start taking them seriously. Even after this incredible run, it's not too late to join them.